Hi, welcome back to Father and Son Investing. Something happened this week that hasn't happened since November of 2007. And if you are a bond investor, there is both good news and bad news in this. We're going to talk about what's happening in the bond market right now. Today is not necessarily about Treasury bills, although I may touch on them lightly. We're going to be talking about the longer US Treasury securities. So let's get started. If you are a bond investor, you have been paying close attention to this number right over here. This is the 10-year Treasury note yield, and it closed at the highest it has since November of 2007. That was right before that Lehman Brothers meltdown that occurred, and of course, the Great Recession. Now, what is it that is driving this number up to its over a decade high? We're going to talk about two factors that happened this week and what they mean. The first bit of news that we're going to talk about, although not necessarily the biggest bit of news, is the retail sales report that came in this month. This little graph here shows you what retail sales have been doing from month to month, and you'll see that when the July retail sales report came in, it was up compared to June. What does this mean for us? Well, it tells us that shoppers in the United States are still shopping. We're still out there spending money, and we spent more of it in July than we did in June. Now, obviously, it's not as big as it was back there in January when it was a whopping 2.8%. But still, those numbers are going up, and that may have effect in the mind of the members of the Fed committee. Now, speaking of the Fed committee, that was the other bit of news that came in this week. Let's go ahead and look at the minutes from the FOMC meeting from July of this year. My take on the meeting minutes is that there's a little bit of a mixed message going on in there, which can make it confusing. A little bit more, talking about a mixed message here, there's a key phrase in this one. It says, amid these economic conditions, almost all participants judged it appropriate to raise the target range. That almost all is significant because at the last meeting when they raised rates, it was a unanimous decision. But this time, there's a little bit of a fracture here. We'll see that it says a couple of participants indicated that they favored leaving the target range for the federal funds rate unchanged, or that they could have supported such a proposal. So there were at least two, if we take the term couple, of those participants who really favored leaving the rate the same, or that they could have at least supported such a proposal. So a little bit of a fracture here, a little bit of a mixed message. However, here's the big statement that really, I think, affected the bond market out of these minutes, and it's right here. Most participants continue to see significant upside risk to inflation, which could require further tightening of monetary policy. Also of note, when it came to the actual vote, remember there's only 11 voting members of those 18 committee members. When it came to the actual vote to increase the federal funds rate, notice here it says voting against this action, none, because all of those 11 members voted for it, and that's really what counts in this year. The other 7 members, will assume at least 2 of those were some who were in favor of leaving the rate the same, while they can, express their opinions during the meeting. When it comes to the vote, it's these 11, and they all voted unanimously to do it. Now, here's a graph that I think really shows what's been happening in the bond market over the last several weeks. What I've done here is pin the interest rate in red from August 17th, 2023, and then I've gone back to when the last Fed meeting was in July. You can see across the board here from the 1-month Treasury to the 30-year Treasury and everything in between what the rates have been doing. And notice how at the long end of the spectrum here, looking at the 2-year to the 30-year, the rates across the board from 2-year to 30-year Treasuries have gone up significantly since the last Fed meeting occurred. What we get out of this is that investors are turning to the higher, longer sort of perspective, meaning that interest rates will at least remain at current levels for longer, if not going higher. And so investors are expecting a better return on their investment. What is that doing to the bond market? It's causing a sell-off. You may have heard that term, bond sell-off, going on, and maybe that gets a little bit confusing. Let's just talk about that quickly as we wrap up our discussion. We're going to use a couple of graphics just to illustrate what's happening here. You may be asking yourself, if bond yields are going up, then why is there a sell-off in the bond market? Well, it has to do with people who already own bonds, not people who are looking to buy bonds at these high yields. But say you own a 3% yield bond, and now rates have gone up to 4.3%. Well, the value of your bond has just gone down. When I'm talking about the value, I'm talking about the price someone would pay you for it. Why is that? Well, as interest rates rise, bond prices will come down. Because if I want to buy your bond, why would I buy your bond that only yields 3% when I can currently get 4.3%? So the price of your bond has to come down enough to make the yield be 4.3% for me. That's the bond sell-off. Now, why are people selling off? It's because they're anticipating that interest rates will remain at this current level for longer or potentially even still go higher. Knowing that, they're selling off now before those interest rates change and the value of their bond goes down even more. So that's what we see happening here. As bond prices fall, the bond yields rise, which is really great for people who want to buy the bond now. They're seeing all-time highs. But if you already owned bonds before, well, that makes you a little sad because the price that you could sell your bond for has gone down. So what's the take-home message from today's video? This graph here really explains it. When it comes to longer-term bonds, they're looking more attractive, and the yields now are higher than they've been really since 2007. Should you be buying now or should you wait? I don't have a crystal ball for that, but what I can say is that the yield looks very attractive right now, and it may be worth dipping your toe into some of these, particularly at the shorter end of these long-term bonds, waiting to see if the longer end goes up even more as that inverted curve starts to adjust. What do I mean by inverted here? Well, if a bond market was acting normally, the short-term yields would be less than the long-term yields because you would expect to get a premium for taking the risk of investing out 30 years. That is not the case with the current bond market, and it hasn't been that way for quite some time now. If any of this was useful for you, give us a thumbs up, please, and we'd love to have you subscribe. Share this kind of information with a young person in your life. Get them investing. And as always, until next time, enjoy your investing.